Good morning, everyone, and thank you for joining us for our Q2 update for the Prescient Balance Fund. As you'll see a little bit later, we've got Bastian and Rupert joining us on the call today. Rupert being based in the Cape Town office, and Bastian's currently in Munich in Germany, trying to find the Euro trophy that Germany missed out on recently. So if we do have any connection issues, we'll make sure that we keep everything on track. But just a basic intro and just a bit of an update what we've seen in the last sort of quarter. Bastian's going to be discussing kind of the principles and the way that the fund's managed, where Rupert's going to take a deeper look at some of our indicators, what they've shown us over the last quarter. But just to start things off, the fund's just reached a 7-year birthday or anniversary, which is fantastic for us. Shows some great returns over the last 7 years and managed to rank 8 out of the high equity category since inception. So it's a really strong performance from the fund. And also a big one for us and a nice win for us, and an accolade is being included onto the Glacier shopping list. So without further ado, I'm going to hand over to Bastian, and he's going to start off with a bit of an introduction to the fund and how we look at things.
Thanks, Jason, and thanks to everyone for joining once again. So I'm going to start a little bit by speaking about our investment philosophy. You've heard it quite often by now, but I think it's always important to recap. So we obviously subscribe to systematic investing. That's what we believe in, and that's what we are convinced will give us outperformance. And there's a reason for that. So let me start by actually just once again recapping what does systematic investing really mean. So for us, it means that systematic investing is rational. So we don't believe in market timing. We believe in time in the market. Time in the market, and it was a strong process, will give us an edge, but you have to be rational about it. You have to understand that you'll not always be on the right side, and there's probably not even a point in trying to time the market and catching peaks or troughs. Systematic investing is also rules and evidence-based. So what that means is we do believe in process and not in predictions. So we do think that a strong process will through time give you outperformance. And it's not about trying to make the best or the most innovative story, and it's not about to predict or giving a point forecast. It's more about a strong process through time will give you an edge. And lastly, systematic investing is data-driven. So what that means is we believe in numbers and not narratives. So our story is not always the most exciting one, because very often some of the stock picking stories have some great insights on how innovative Google, Facebook, or the likes are, and we don't have these sexy stories for you, but I don't think we need them. So in terms of processing information, we are processing more than 100 million data points every day, and we do think by doing that we do have a natural information edge, and that's just so much more important for us than having a nice sounding story. So all of this leads to unbiased decision making. We can prove that during COVID, we created a little bit of outperformance. During the crash, we created a little bit of outperformance during the recovery. Our decisions have always been unbiased. We didn't catch the peak before the crash. We didn't catch the trough at the end of the crash, but that's not the point. We went with our process, and our decisions have always been rational and completely unbiased. Clear strategies and processes, that's what's necessary to create outperformance, and that's what we've achieved. So all of this together creates consistent outperformance, and consistency is almost the more important word than outperformance. So yes, we want to create outperformance, as we all do, but for us, it's really also about the journey. It's not about just getting a good outcome, but we also want to get there traveling safe and without too much of a turbulence. Okay, so a lot of talk about systematic investing. Now, how do we achieve all of this? I will put some numbers behind our story so that it's not just a narrative, but let me start by doing that by zooming out a little bit and highlighting that over the long term, it's really the strategic asset allocation which drives your investment return. So we really think it's important to keep the bigger picture in mind, and that's why we always start with this quote from Brinsenhut and Bibuber. We basically say investment policy dominates investment strategy. And he actually, the research of those three guys actually goes as far to say that almost 96% of your investment return is defined by long-term investment policy. Okay. So let's check if that's true. And for that, I brought it all back to South Africa, and we thought it's interesting here to basically give you an example by basically comparing the high equity category against the income category over the last 5 years. So over the last 5 years, we are comparing now the average income fund in red against the average multi-asset high equity fund in blue. So it's not the Prescient Income Provider Fund, which has actually beaten the average income fund over this period. It's also not the Prescient Balance Fund, which also has beaten the average fund in the high equity category, but that's not the point. I just want to say here, by moving into income instead of multi-asset high equity, you would have generated 13%, 13% of outperformance over the last 5 years, which would have been a great, albeit risky, but it would have been a good call. It would have not really mattered whether you had that 1% Steinhoff in your portfolio or not. It would have not really mattered whether you had like that 1% land bank exposure in your portfolio or not. That would have not really made the difference. The asset allocation call is what would have made the difference here. But should we now move all to income? I don't think so. I think the opposite is the case. So let's zoom out a little bit and really focus over the long term. So now if we look at basically a longer term period, now we've just zoomed out to a 20-year period, you can see that the average multi-asset high equity fund has beaten the average income fund by more than 300%. Again, this is no marketing for Prescient. This is just plain facts. Well, our funds are playing a part here as well, but obviously what we just want to show is having the right long-term asset allocation mix is just the single most important investment decision you can have to make. Okay, so then now your life is easy, right? So you need a high equity balanced fund for investment periods, 10 years, 10 years plus. And I think that's obviously with interest rates being so low and the economic picture looking more positive, it's probably more true than ever. So you need a balanced fund, but your problem is a bigger one. You also have to choose the right balanced fund. And especially if you move into the balanced fund, that is absolutely crucial. So you might actually get away with choosing not the very best income fund, because what that means is that maybe there's a few basis points or a few percentage points of underperformance. But if you manage to choose the wrong balanced fund, you're in deep trouble. And you can see, again, the balanced fund is a blue line. We've done very well. I mean, Jason gave the marketing story at the beginning of the presentation. But what I really want to get here is more the gray lines. So the dispersion between the balanced funds in this category is just absolutely mind-blowing. And if we compare the first fund in the category against the last fund in the category, you are actually looking at more than 100% dispersion. So long story short, it's a massive risk for you to choose the wrong balanced fund, and you really must make sure that doesn't happen. Yeah. So how can we make sure that it doesn't happen? And that's actually the key question which we at Prescient aimed to answer. So make sure that you don't have an underperforming balanced fund. It sounds easier said than done, but it is just absolutely important. And that's where all the focus on this product has gone. And we've achieved it. So let me put some numbers behind the story. We're showing 1 year rolling return here. The gray lines are all the funds in the category, most of them stock pickers, some of them active in different ways. We are also very active, but we always keep in mind that tracking error is a bad thing, and tracking error leads to turbulence on your journey. And we also carry in mind that it's not everything active which really adds value. A good example is stock picking, having smart stories around it. We really do think stock picking does not add value. And so you have to be active, you have to make a lot of good decisions, but one of those decisions is which part of the active world does really work. So what we've achieved with our balanced fund, you can see it in this slide, is it's only basically 3 very short periods where we've dropped below the 50% line. And that's one is in 2016, the other one in 2017, the other one in 2019. Since then, we've never ever dropped again below the average line over 1 year rolling. And that's just massively important, because if you manage to be consistently better than average all the time, you basically get to a top quartile fund to almost 100% of the time, or a period of only 3 years or longer. Just remember, and it's simple math. If you have a fund which is second quartile in year 1, second quartile in year 2, second quartile in year 3, it's not going to be a second quartile fund. It's by a wide margin going to be a first quartile fund. And that's because of the power of compounding. Always being better than average takes you to the top through time, and it actually doesn't, and that's this chart shows, it doesn't really take you all that long. Okay, so steady performance, reliable performance, that's all we want to achieve. And let me now drill into like how we get there. So our starting point is really a pure passive fund. So look at the left-hand side of the slide. We start with low fees. Our balanced fund has only 30 basis points management fee. That is just super important for us. That's in line with the pure passive, and that's probably the key reason why the pure passives beat the pure actives. We've also got low transaction costs, and that's where we already have an edge against the normal pure passive. Pure passives also have low transaction costs, but our transaction costs are even lower. So just to give you an example, with our portable alpha process and the way we get exposure in a very efficient way, we really managed to move those transaction costs to a much, much lower state than any of our peers. We trade our equity futures through in-house through our Prescient securities business. What that means is the brokerage we pay on an equity future trade is 0.3 basis points. So 0.3 basis points, not even a third of the basis points which we encounter in terms of transaction costs. How liquid are those futures? Those futures on average have a bid offer spread of 3 basis points. So if you trade them smartly, you end up paying maybe a 1% bid offer spread. So we're literally looking at transaction costs for our equity trades just above 1 basis point in total. Look at a stock picker now. So what has he has to pay more brokerage. He has much higher bid offer spreads for small caps. And even if all of that would not be existent, he has to pay 25 basis points STT. So there's absolutely no way that any stock picking fund or any more active physical based balance fund than us could be anywhere close in terms of transaction costs, in terms of what we're trying to achieve. And last but not least, low tracking error. We don't want to be first in the category. We don't want to win the raging bull for a 3-year period, because to do that, you need to be very bold, you need to be very brave, and you have to move away from your peer group by a massive margin. And we don't want that. So we want to be better than our peers every single year, and then we want to go through the top through time, and that's what we achieve. All of that is pretty much in line than what the pure passives do. I think it's a little bit smarter, especially on the implementation and trading side, but it is quite close. So how do we differentiate ourselves from them? We differentiate ourselves from them by bringing in the active element. So the active element which we're bringing in is an efficient allocation of capital. So what that means is we have a strategic asset allocation which constantly updates, which constantly improves, and which is basically re-optimizing almost on a daily basis. We are capturing market dislocations. So what that means is we are highly active on the TAA front. We would put in TAA trades whenever necessary. We would put in TAA trades whenever there is significant market dislocations, and we see that the odds are in our favor. And we use a lot of portable alpha. So within all the asset classes, we try to get the exposure, not physically, but synthetically, and then we generate fixed income alpha. This is where we are good. And then we use fixed income alpha and port it on top of equity beta to get equity beta plus fixed income alpha, which is a perfect combination in a balanced fund portfolio. So this combination gives our Prescient balanced fund, and it leads to exactly the outcome which we like, which we're trying to achieve. So just to recap, the 3 sources of stable outperformance. The first is our strategic asset allocation at the top left is not static but dynamic. Speaking strategic, not tactic. Structural breaks, changes to inequality, changes to the long-term economic growth forecast, changes to regulation, all of that features, and we update our strategic asset allocation and we adjust it. Second, systematic tactical asset allocation tilts. If we see certain asset classes as particularly attractive, we go with it as a TAA tilt, and it gives us an edge. 3, portable alpha, and it's fixed income alpha, which we port on top of equity beta. That is also very important, and it helps us to give us that edge against the pure passive again. So 3 reasons why we are much better than a pure passive, 3 active reasons, and still we're not talking stock picking. And then at the bottom right, you can see low investment fees. So low investment fees are a straight driver of investment return. We all know that there is a straight correlation between investment success and low fees. That's obvious to us, but we are better than just having low fees. We would have just low fees, we would be sitting on the left-hand side of this regression line. So our return would already be much better than average, but we sit above the regression line. So what that means is, yes, we've got low fees, so we give you that benefit, but we also have an active element which actually works and which actually contributes positively. Okay, stability of the return, also a key feature on this slide. We haven't updated it for 2021 because we only want to update it for complete years. But I can tell you already now, 2021 looks quite similar so far. In the last 7 years, which we've basically been running the fund. 3 out of 4 times our strategic asset allocation has given us an edge against the benchmark. TAA 6 out of 7 times, and this year again, our TAA calls have contributed positively, and Portable Alpha 7 out of 7 times, the contribution from Portable Alpha was positive. So remember, everything here happens in narrow, quite risk-controlled and predefined trading bands. So we are making sure that there's not a lot of tracking error added. Our Portable Alpha is only a few basis points. Our tactical asset allocation tilts only at a few basis points. A strategic asset allocation is close to our benchmark, so only adding a few basis points. But it's 3 truly uncorrelated sources of alpha which consistently put us ahead of a pure passive strategy. Okay, so this is basically just the concept highlighting once again in a different way that through time, if you are first and second quartile, so basically better than average, call it in this instance 85% of the time, which is the very left-hand bar on the slide, then you're already achieving quite a lot. The fact that we've never been in the fourth quartile and less than 15% of the time in the third quartile, if you do that so consistently, and then you look at the 3-year period, you're basically only having first and second quartile performance, almost only first quartile performance, less than 8% second quartile performance, more than 92% first quartile performance, and then 5 years and longer, yeah, then you're gone. So obviously first quartile, and you won't drop out, simple as that. So yeah. Let me move on and look a little bit into some macroeconomic trends, basically less about the philosophy, less about what we're trying to achieve, more about markets and where we are right now. So I'm starting off by looking at performances for the major asset classes just for 2021. So we're moving slightly more into the short term now. We had 1 or 2 major themes for this year, and they've played out quite nicely. The one theme number 1 that was that we are quite optimistic on growth assets. Growth assets, particularly those ones where risk premia are still elevated. We had a very positive SA theme, which we got questioned on a lot. So the asset classes which we liked most were SA sovereign bonds, SA property, SA nominal bonds, SA high yield corporates, even SA preference shares. We got a lot of flack for our property call, but it turned out to be the strongest TAA contributor this year. And then we've also been positive on risky assets on the right-hand side of the chart. So you can see that more positive on global equities, more positive on global property. All of that has actually contributed positively, also more positive on small caps. So all of that has helped. And then the underweight we had in the haven asset classes like global income, global bonds. Those are the asset classes which we liked less and which we still like less. And just to illustrate how the SA theme really comes through, it obviously also comes through in a stronger rand. So if I switch all of these dollar returns now into rand returns, you can now see that the SA side of things really stands out. So I'm going to speak about our current positioning a little bit later now, but I can already say now that we are remaining quite positive on SA. We're remaining very strongly positive on the rand. Even at current levels, we're remaining strongly positive on SA government bonds, SA ILBs, SA preference shares. So we like that stuff, and we like it for a reason, and we're going to speak to that more. So what's the biggest risk to that? I don't think it's COVID, but COVID is a potential risk, and I think we should speak about it as well. So why is COVID a risk to an SA investment? Mostly driven by what you can see on this slide. So we are really looking at a post-pandemic world if it comes to the developed world. I mean, as Jason said, I'm in Germany right now. I can tell you infection numbers are very, very low, and basically everybody on the road is vaccinated. So that's quite encouraging. That means that the virus will go away. The problem in SA is we are a little bit behind the curve, and that's why we are experiencing this third wave. And that's also reflected in this chart. So you can see that in SA, the vaccination rate, which we've achieved so far, is just too small. And it's just so far behind what we have achieved in the developed world. And that's quite sad. And I just want to highlight here as well that we are on the right track now, and we're getting more vaccine supply, and we've made all the efforts to pump out those vaccinations quicker. And I also want to highlight that it's too easy to just once again blame our government. So I think there's quite a few external forces which were out of our control. We had the disaster around AstraZeneca not being able to protect against the SA variant. This is something which nobody could have foreseen. We had some significant issues with the supply from Johnson & Johnson, which is completely out of any SA hands. So let's not just be too easy and once again blame our government. It's not always that easy. I think there's more to it, and I think we are on the right track, and we'll get it right in SA as well. So that's not the question, and it's not by any means derailing our positive story on South Africa. One side which is also a little bit more encouraging, especially as we are experiencing the third wave in South Africa. On the left-hand side, you can see the number of new cases compared to wave 3 against wave 1 and wave 2. And you can see, especially in Joburg, you see that the numbers and the cases are really bad. And it's starting to hit us harder in the Western Cape as well. And what we can see is that, yes, the third wave comes with a higher infection rate than the first and the second rate. Something slightly more encouraging, hopefully, because we haven't seen the full truth and the full story yet. On the right-hand side, we can see that the mortality rate is actually lower in the third wave than in the second wave. So we have experienced far less deaths. That's obviously the most important thing. And I think just to highlight here, if I look back a little bit into the history, we just wrote an article also about the Spanish flu. It's a natural pulse of a virus to basically become more contagious, but at the same point, less deadly. And it looks like that's what we're experiencing with COVID as well, which is a little bit encouraging. But yes, I think obviously we should just sort out our vaccination story and then we're all fine. Okay, so this is basically a story around our investment philosophy, a little bit of look back on market returns, and a little bit of view on COVID. And I'm going to hand over to Rupert at this point in time to take on some of the macroeconomic trends before I will come back to you to speak about, once again, performance and our investment philosophy.
Thanks, Bastian, and thanks for all of you for joining us today. I thought we'd focus on 3 core themes for this update. Every one of these themes does play into our investment process in some way, shape, or form. So I'll be showing a relatively large amount of data, but a lot of those data points actually do feed into our models, which is important because, we're not just talking the talk, we're actually walking the walk, if you like. So the first one being inflation in the United States, why that doesn't really concern us. And I say it doesn't concern us, but on the next slide, I say it doesn't concern us yet. So just a proviso there, there could be a scenario where inflation does overshoot, and then we're looking at a scenario where things are not quite as rosy as they seem at the moment. But I just thought, let's look at it as a historic roadmap as to what inflation means, and historically, and this is going back 50, 60, 70 years, what inflation has done to asset classes, in particular equities and bonds, in certain environments of inflation. So if we look at the level of inflation being low or high versus the direction of inflation being rising or falling, you get these 4 broader regimes. So you get pure inflation, disinflation, reflation, and deflation. What we are looking to be in is best case disinflation. Second best, I guess, for the multi-asset space is reflation. And then because we have diversifying fixed income assets, deflation is also not too bad a space to be in. You don't want to be in an environment where there's high and rising inflation. So that's the question on everyone's minds. Are we currently in an environment of high and rising inflation? So if we look at this chart going back since the early 90s, if we look at realized inflation in the dark gray color, you can see that it is volatile. It does go through periods of peaks and troughs, 2008, and then the recovery being a very good example of that. But it also is almost muted by the 30-year inflation swap. So that's the forward-looking view of the market of where we're going to see inflation going for the next 30 years. The question is, are we in a high and rising environment? And by the looks of this chart, you would argue perhaps we are. We are in a high inflationary environment, and thus far inflation has been rising. Last print at 5%. Inflation expectations going forward currently at 4.9. So arguably flattening out, which would suggest that it's transitory is the key word, I guess everyone's been bringing up. But the question is that indeed the case? So if we look at it going back even further, this is to the 1940s, post World War II, so you can almost exclude that area, but you can see how high inflation is actually relative. So, arguably we aren't in as high of an inflation, especially not a runaway inflationary environment as yet. There is certainly rising inflation, As mentioned, it might have peaked, but we are certainly not in a high inflationary environment if you compare it to the 70s and early 80s. So looking at it in a different context, that was on the United States. If we look at it across the world, so now we're looking at inflationary comparisons across the world, a heat map. So looking into blue being low inflationary environments, looking into just post the outbreak of COVID, so March 2020, you can see how inflation generally dipped across the world. So we're coming from a low base. And what we've seen more recently is this bounce in inflation, which is logical. I mean, if you're coming off a low inflationary base and you're going back to long-term targets, you are going to have a reflation over the short to medium term. So that is a theme that we're seeing in global markets at the moment, and I'd argue it hasn't really played out to the full extent as it might do to rebound off the low base it was originally on. And then another way of looking at this is the Fed recently switched to inflation averaging, and I looked into what this actually means and a way of showing this. And we usually see inflation as plotted along, simple year-on-year inflation prints. But if you look at inflation as a time series, you can see the inflation as a time series in dark blue. That's actual printed inflation, and the Fed since '99 has had this 2% inflation target. Where they've been trying to hit that dotted blue line, or dotted grey line at least. And you can see prior to GFC in 2008, they were overshooting. In other words, the economy was running very hot. And then in the more recent period, they've been undershooting. So the economy has arguably been running relatively cold. What we switched to last year or the year prior is inflation averaging, where we're looking at the past 2 to 3 years inflation prints, and we're looking to average that path or smooth that path through time towards that 2% inflation. And if you look at it in the context of the recent print, we're actually not very far off that inflation averaging target. So that's arguably why the Fed has been holding back. And we've seen that in recent, yesterday's minutes from the Fed, not too worried at all yet on forward-looking inflation. So what's the market thinking of this? This is a relatively complex chart, but this is your 5, 10, 30-year market pricing on inflation swaps. And you can see much of the same kind of playbook has played out this time as what happened in 2008. So we have this dip in inflation, then we have a bounce in inflation, and then what I call normalization of inflation, where at least expectations come to within a very tight band. And then again, we had this dip in inflation, this bounce in inflation, and now the question is, where do we sit going forward? And you've seen that more recently, over the last 2 to 3 weeks, the market has been decreasing in its inflation expectations, cooling down on that inflation overshoot trend that was potentially to come through in the markets. So going back to this historic roadmap, where would I say we currently are? I mean, arguably we're in the period of low inflation, still rising, but not at extreme levels, which means that we're looking at a trade which is good for equities and relatively bad for bonds. And this is in the global space. And Bastian showed how that trade has largely played out through the first half of this year, where we've had growth assets on a positive rebound, and then not really all that good performance, in fact, negative performance for the general fixed income assets in the global environment. So what to watch out for in South Africa? A slightly different playbook here. We've seen this these decreases in private sector credit extensions in the green, as well as decrease in M3 money supply. So basically liquidity is drying up within the market. Banks aren't comfortable in issuing debt, and on top of that, businesses aren't comfortable in taking out debt. What that generally means, again, in the kind of inflationary playbook, is that you have a downward trend in inflation because there's simply less money within the system, and that decreases inflation. What's interesting, though, is that more recently we've seen a very similar trend to the kind of 08-09 scenario, but inflation has remained stubbornly flat to positive. So the question then, I guess, is within South Africa, are we going to see a decrease in inflation going forward? And then just one more point, and this goes beyond the transitory argument that we've been hearing so much about, looking into other sources of inflation. And this is one point that we've seen picking up. If you look at oil futures, so oil is an environment which is largely stimulative of inflation, being the backbone of a lot of assets. a lot of expenditure. You're looking at oil futures currently approaching almost 100, which over the historical trend has generally fed inflation. So that's one thing to watch out for with the markets going forward. Okay, so that's inflation. Then that leads into easier financial conditions, and we've seen this as a theme with monetary stimulus from the Fed, fiscal stimulus from the US government, fiscal stimulus from the South African government, and what does that mean, and is it going to last for longer? So I mentioned the Fed put out their minutes yesterday. What we're seeing at the moment is we're seeing a very muted rising in the Fed funds rate going forward. The first Fed funds increase looking at sort of mid to late 2022, so in a year's time. But just to put in context the scale, and this the Fed fund futures over here, which has picked up, and this is over now 2 years forward. This is to 50 basis points on the Fed fund rate. So that's something which is still historically very, very low and still very, very, very stimulus based from a financial conditions perspective for global markets. So certainly a positive picture painted within this space. Then for the Fed and the stimulus packages that they've been putting into the market, if you look at the Fed's balance sheet, you can see that has been steadily rising since the start of the COVID scenario. They continue to add balance sheet, they continue to climb, implying that we haven't seen a leveling off or indeed a decrease within the Fed balance sheet. And for now, that looks like it's going to continue. So that's something which we don't think is a risk, if you like, towards the growth scenario. Okay, but I thought let's look at it in a different way, a different context. So if we look here at the number of quits or percentage quits within the United States in the workforce, you can see that there was a steady amount of quits. If people are voluntarily quitting their jobs since 2011, and that's actually the result of upskilling. So unemployment has at the same time been decreasing. We saw that through the Trump era. So we've seen a positive influence on the US economy and as an offshoot, the global economy. Interesting one though, if you look at the post-COVID scenario, the quits have increased drastically. And that basically talks towards these massive stimulus packages that the US government has been pumping into the United States economy at least. And what that shows here is if you look at total employment in the labor force, and considering that there hasn't been much change in US population, you can see that there was a massive either quit or layoff within the US economy, but that hasn't recovered. Meaning that there are a significant amount of people within the United States who are essentially living off the stimulus packages. There's no real incentive to get back within the labor market. So is that really a concern for us? You can see here now in this dark orange line that unemployment rate has come right back down. So it shot up at the most violent rate on record and then came right back down very quickly with all the stimulus pumped into the market. It's not near where we were sitting at almost full employment here, but it is certainly close to it. If you contrast this with total job openings, you see that there are a significant amount of job openings within the US market. In other words, jobs available but not yet taken up. And if you push that forward, once stimulus stops, people will be more inclined to go into the job market, and there are jobs available for them. So that for me is as an indicator of why there is not necessarily a negative case for growth within the United States, and it could potentially be a positive outcome for the growth story globally. Looking back locally into South Africa, if you look at the MPC and the votes and the latest MPC meeting, March 2021, you can see that every single member of the 5, they all voted to hold. And we believe that despite what there might be in forward guidance from the MPC, they largely follow the Fed. So, and that's true across the globe. They generally work in tandem. So we see not nearly as much risk as perhaps the market is pricing for rate increases in South Africa. There will be 1 or 2, but they won't be significant. And that for us proves to be quite a good stimulus for the growth sector of the economy once again. Okay, so taking this back into what that means for our multi-asset models, risk premia, whether they've decreased, increased for South African assets in particular. So how we build our risk premia, our long-term expected returns, Bastian mentioned there's a massive focus on the long term for our multi-asset funds. And to build our risk premia, we build up these, at least long-term return assumptions, we use risk premia as building blocks. So currently we're looking at our highest expected return asset class of South African equities, followed by SA property, and then alternatives, which is our clean energy fund. And then you're looking at things like high yield corporates and prefs being fourth and fifth. Cash at the moment is a very low long-term return expectation. In fact, if we take our expectation of a 6% long-term inflation rate, then we're looking at negative real returns on cash going forward for the next 30 years. So for us, that means that as an asset allocator, you have to shift your allocations marginally, but still shift them slightly up in the risk spectrum in order to achieve the same long-term return profile as previously was targeted. And then just talking towards that as a global trend, this has been a trend since the 70s. This is now the earnings yield, the inverse of the PE ratio for the S&P. You're seeing this downward trend, which is basically analogous with the search for yield. So you're getting extremely low, if not negative yields within the fixed income space offshore. And as a result, even the fixed income or more cautious managers are having to branch out into equities, for example, in order to achieve their long-term return potential. So what that means is that you get a compression in earnings yield, an increase in the price to earnings rate. And in other words, people are willing to take on more risk for taking on marginally less returns. So taking that into the South African context, we've also seen a compression over the longer run in the emerging market equity premium. In other words, what you're going to get by taking emerging markets over and above developed markets, which there is a higher amount of risk in, so you should be paid for it, but that has been decreasing over the longer run. Same story within the emerging market bond premiums, but what you see here is that there is a very much a sharp reflex trade. So in the GFC and in the COVID scenario, you see the premium on yields blowing right out and then coming quite steadily back in towards the long-term median. So that long-term median is lower in our expectations in the dark blue line than the historic long-term average. And that just talks towards that compression in the yield profile over time. Okay, so that's three pillars of where we're seeing views on the markets, which come through in our systematic positioning in the funds. Bastian's going to take you through where we currently stand, bringing those views into the real space of the weightings within our balanced fund. But that's just to tie it in from Bastian being at the very high level, and then me taking it into the macro sense, and then now Bastian to take it into the actual real life sense of our Prescient Balance Fund.
Thanks, Rupert. And yeah, so let's, as Rupert suggested, so we started a very top level philosophy of the fund. Rupert gave a detailed view on the themes which we are currently seeing, and obviously all of this feeds into an indicator set and it is then captured completely systematically as Rupert described. So what I want to talk about now, what is really the result of this? And we're going to basically take you through our house view, and I'm going to start with equities and bonds. And as always, you can see on the y-axis the different regions for the different asset classes, and on the x-axis you can see whether we are sitting at a strong, moderate, underweight, and neutral, strong, moderate, overweight. And I mentioned already in the introduction, very positive view on SA, that's still in place, very positive on the South African equity market, very positive on the South African bond market. Both of them we expect very high returns, significantly higher than the long-term average. And then overall, if you look at the equity space, we remain quite optimistic in general. So we like also global equities, and that basically spans across US, European, and emerging market equities. It's just to drill into these factors a little bit more in detail. It sounds like almost a bit too optimistic, or maybe a little bit too racy, given how expensive valuations are. But just remember, back to our setup, we are looking at valuations, economics, financial conditions, and sentiment, and we do acknowledge that valuations are very stretched across the equity space. But right now, with easier financial conditions than ever before, with very positive sentiment and a very strong turnaround in the global and South African economy, those factors are currently really overcompensating us for the risk we're taking. And there's a reason also why Rupert spoke a lot about inflation and monetary policy, because obviously that's a key risk. It's a key risk because it's a factor which might turn fastest. As soon as we see financial conditions to tighten, i.e. the Fed basically putting on the brakes, that will immediately switch or shift this whole positive outlook slightly further to the left, or even all the way to the left, given how expensive markets right now are. Okay, credit, I'm going to skip that, a quite balanced view. Again, SA we like more than other regions. We don't like so much emerging market credit risk. That's something also to note. And then in the real asset space, there's one a big theme, basically us being very positive on all SA, but also DM linked real assets. So we really like DM property, we like ILBs, we like preference shares. We're neutral now on SA property because we saw a quite steep collapse in earnings. So all of this means suggests we are well positioned for a rise in inflation. What you can see at the bottom of the page is our currency view. So we're kind of positive on very positive on every single currency against the dollar. So if you translate that, it basically means we are seeing the dollar as quite negative. So we like the euro, the pound, the yen, all of them much more than the dollar. And last but not least, our strongest overweight is really on the South African rand, where we see a further strengthening even from these levels. And we are very well aware that the rand had a very significant rally behind it already. Okay, so what does it mean to our asset allocation mix? So as I said, we are taking tilts in a very risk-controlled, predefined and measured way. So on the left-hand side, you can see our strategic asset allocation, which is also updated, dependent on the structural breaks. But then on the right-hand side, you can see the current fund positioning depending on those factors, valuations, economics, financial conditions, and sentiment, and what we observe there in the individual regions. So you can see SA equities, we're adding 5%, so we're moving from 40 to 45. The reason for that is that we like the asset class a lot and that we are so positive on SA equities. You can also see on the left-hand side, if you look on the outer ring, so the currency hedging, that the dollar hedge is larger on the right-hand side pie chart than on the left-hand side pie chart. But structurally, we hedge 5% of our dollar exposure. So basically running 30% offshore, but just 25% dollar exposure. Right now, we've reduced that further. So right now, the dollar exposure drops because we're hedging the rand more aggressively. And we're also putting in other currency pairs. And then if you look at the top left, also DM bonds. So we strategically run with 4% developed market bonds. Right now, we're just running with 1% developed market bonds and more developed market income assets because we really don't like DM bonds as an asset class. Okay, so that's basically in a nutshell the current positioning and basically reflective of all the trends we see and obviously always, and that's most importantly, the pie chart on the right-hand side for me would be completely meaningless. The themes and the TRA positions which we suggest would be meaningless, and all the macroeconomic outlook would be meaningless if we don't know what the base foundations or the strategic asset allocation on the left-hand side is. So that's where also a lot of effort has to go, and that's something which is very often neglected in SA. Okay, so putting it all together, so kind of like the right time now after 45 minutes to summarize where we stand. So the Balance Fund now with a more than 7-year history has done exceptionally well. We are number 8 in the entire category, and we really stand out in the way that amongst the funds with a limited tracking error, we are really by a wide margin the number 1 fund. Yes, there's always somebody had somebody a little bit better, which we completely accept. Because that necessarily involves more risk taking. So you get the guys which are very brave in their stock picks and which are very brave in their asset allocation tilts. And we can just say we congratulate them to the performance they've achieved. Also would be I don't want to say too many other don't want to talk too much about our peers here, but some of the guys have done very well, which is great. But it's just not our journey. So our journey is to go to the top in a smoother way, in a more risk-controlled way, and in a measured way, and not to be too brave on all of the calls. On On the left-hand side now on this slide, you can see again the performance of the balance fund against the benchmark and against the South African multi-asset high equity category. What really stands out to me here is not that we're beating the benchmark and the category across periods. What is more important for me, oh, that is the most important thing, of course, yes. But what is also an interesting highlight is that the benchmark, which is a static asset allocation, but just comes at 0 fees because we have a composite benchmark, that this composite benchmark is already beating the high equity category by a wide margin. And that's an interesting one because it's a perfect proof that the traditional active approach, which mostly uses stock picking, and the traditional way of charging your client, i.e. high fees, that in itself is really inferior to a static, simple strategic asset allocation which doesn't change. So that's quite a statement, and that's what this chart, if you just compare the benchmark against the category, proves. So yeah, a static, never changing asset allocation is already better than what we're seeing in the market on average. But of course, and that's what stands out, the balance fund has managed to beat exactly that benchmark. So we're setting the hurdle a little bit higher than just comparing us against the peer average. So we're setting the bar higher by comparing us against a composite benchmark, which is traditionally just much tougher to beat. Spoke in the beginning a little bit about the performance of multi-asset high equity funds against multi-asset income funds. And I mentioned that the average income fund over the last 5 years has beaten the average balanced fund, but over a longer period, the average balanced fund has beaten the average income fund by a higher margin. So on purpose, we took out the balanced fund in the beginning because we wanted to really focus on the asset allocation decision behind those slides and not on our balanced fund. But what I want to throw in this slide is to show actually our balance fund actually has beaten the income category and it has beaten all the other categories. So yes, asset allocation is key and it's very important. But if you just don't mess it up, if I may put it like this, and are cautious in terms of adding a few basis points here and there, you don't need to super brave TRA calls. You don't need to move your equity exposure all into income and income exposure all back into equities at time. Go with a sound process, go with something which takes care of all of that for you. And ideally somebody who does that for just 30 bips, which is us. So that brings me to my last slide, basically just combining the best of both worlds, passive and active. So passive, we understand fully why this trend has emerged globally, why we've seen this strong push for passives. It is all the factors, low fees, low transactions, low tracking error. That is not going to change. This push towards pure passives has already evolved in South Africa. It has started. There has been massive outflows from traditional active funds and massive inflows into more passive strategies. That's going to continue. That's one message. The other message is, but you don't have to sacrifice an active strategy for a passive strategy to benefit of these nice features. So with a balanced fund like ours, you benefit from all of that, but you can still jump on the bandwagon, benefit from low fees, benefit from low transaction costs, benefit from low tracking error, but also benefit from the active elements. And that's where we see the future of investing. It is not in between active and passive. It's not about the decision, how much active do I need, how much passive do I need? It's all about, is there not a way to combine the best of both worlds? So is there not a way to combine all the beneficial attributes of pure passive with the nice attributes of the pure active? And that's exactly what we're achieving in this fund. So that takes me to the end of the presentation. Last thing I just want to say is obviously a big thank you once again for joining us. We really enjoy the interaction with all of you. Yeah, if there are questions, please let us know at any point in time. Always keen to answer, always keen for you guys to reach out to us. So yeah, let's keep it up.
Great, thank you very much, Bastian, Rupert. So I've just got a few questions that have come through, and I'm going to place this one more as a scenario. I mean, you can take it how you want. So an average advisor has been convinced, he likes the fund, he understands the principles and philosophy of the fund, and now he's looking to introduce it into, let's say, his model or his current use of funds. So let's, for argument's sake, let's say use the big 4 or 5 names in South Africa. What are the immediate benefits that he would use or see in allocating to, like the Prescient Balance Fund, for example, say, and suppose what are the long-term effects, in this sort of allocation?
I'll try to take that one, and I'll leave the next one for Rupert. So I think one thing which is worth mentioning there is if you really blend the, call it top 5 or top 4 high equity balance funds. I'm just taking the top 5 by assets, so I don't want to say too much about our competitors, but let's say the names Coronation, Allen Gray, Investec, Prudential, and Ford, which are basically the top 5 in terms of size. So if you take the equally weighted blend of these 5 funds and compare them against the Prescient Balance Fund, there's not a single point in time over a 3-year rolling period where that asset class mix has ever reached us. So over a 3-year period or longer, 100% hit ratio of our balanced fund to beat that blend. So that's the one benefit. The second benefit, which you obviously get, if you can combine these 5 balanced funds, and I mean, Jason, you chose this example. So if you take those 5, you combine them, you're pretty much getting the market anyway. So just be aware of that. So you're diversifying these 5 funds to basically eliminate tracking error against the peer group. So fair enough, that to some extent works. So I can't dispute that. The only issue is you're getting the market at a 1% fee. And that's not good enough. So what we can give you is something which does much better, but it does so as an almost 1% lower fee. So 2 advantages: higher return, higher returns, lower fees. And obviously, as we've shown on some of the slides previously, there is a straight correlation between performance and fees. So you're getting both. And then long term, the power of compounding sets in. So what do you get long term from this? Well, your clients pay less fees, you pay less fees, you get a higher return, and you have a much higher likelihood of achieving your investment outcome. So basically it.
Great, thanks, Basti. And then if you're going to go over to Rupert now, I'm going to provide a bit of a technical question that's come through on inflation. So obviously we're looking at US inflation, how it might come through, how it might not come through, and I suppose we all can to a large degree we think that the SA economy or follows quite a strong suit, and it follows that sort of inflationary run. But what happens if there's a bit of a dislocation in the sense of, the US starts to return to normal quicker, they have inflationary come through quite strong, where South Africa is in an environment right now, which Bastian also alluded to, that our vaccine rollout might lag a year. How does that play out in the SA market from maybe a theoretical perspective, and how would you pick that up in your indicators?
Yeah, sure. Thanks for the significantly more difficult question. Okay, so I think for us, that talks towards being inflationary hedge assets. You're looking at being in growth type assets. I mean, inflation-linked bonds is perhaps the easiest one to call on that one. But you do get inflationary hedging within growth assets like property, like equities. I think one interesting point to mention is that our Reserve Bank has mentioned that while there is a 3 to 6% target band at the moment, they've mentioned or reinvigorated the idea of reducing that band first from 3 to 5% and then from 2 to 4%. So what they're saying is they want to trade more in line with our trading partners, which means that I think the risk is actually a lot less or a lot more muted than perhaps is the case or perceived within the markets. The one interesting thing though is that South African inflation does come with an embedded risk premium. So we have the stated 3 to 6% band of the SARB, but then in general, the inflation swaps will price just north of 6%. So that captures or it shows us that there is a volatility in that expected path of inflation, but that's already priced in by the market. So if it's priced in inflation swaps, then generally it's priced in within the asset classes as well. So the risk premium is captured, and I think that also talks towards, for instance, for us bringing our equity markets back into South Africa or emerging markets. We add on a 2% emerging market premium, and that just talks towards that uncertainty around things like inflation, government uncertainty, let's say corruption, things like that do exist within emerging markets. And the thing is that markets do price for it already. So they price that into the risk premium.
Great, thanks very much, Rupert. I'm going to finish off with a last question here. And if you do have any more questions for us or the team, please just reach out to your consultant. So lastly here, we spoke about how we tilt and how the fund tilts away from a strategic asset allocation when there is dislocations in the market. And obviously those tilts are measured. Can you give us an indication of what sort of range you are for the bands, for example's sake? And then maybe secondly, stemming on from that, do you have a hard cap where there be a loss or a profit? You know, do you have a certain strike point, or are those trades open inevitably in, you know, with your indicators pointing a certain direction?
I'll take that one. So firstly, we have a predefined range and a predefined limit, so that never changes, and that's the size of the tilt depends on the size of the asset class weight. So if we have a SA equity overweight, strong overweight, we'll add 5% because it's a bigger asset class. If we have a strong underweight to SA equities, we'll move from 40% to 35%. And then on smaller asset classes like SA preference shares, which is just a 5% strategic allocation, we add 3% on the upside and reduce by 3% on the downside. So that's always predefined and never changes. It is ongoing research for us to optimize for those trade sizes in terms of, like, maybe depending on hit ratios, depending on, again, contribution to overall risk and overall peer relative tracking error. But right now, this is how we go, and we've fared quite well with it. Then to your second point, which was basically more towards not just the bandwidth, but Jason, maybe just the second part, just repeat it again. Sorry.
Yeah. So obviously you've made your trade now.
Yeah.
Do you have
whether we have a stop loss or whether we exit the trade earlier or later?
Correct.
So we don't have a stop loss and we don't have a take profit, and there's a reason for that. So the reason for that is that it's within our process not really necessary. So it sounds a bit arrogant, but the reason for that is we do measure the tracking error contribution of all the individual trades in advance, so we know exactly how much risk they introduce, how much risk against the peer group they introduce. And we know that, for example, with a 5% or 3% under or overweight in a certain asset class, we can afford to run against the peer group, even if we're on the wrong side of the trade for quite a while. So we are quite comfortable that we can afford to be wrong for a quite long period. And that is basically based on a couple of factors. TRA is not just the single contributor to peer relative outperformance. We also have portable alpha, which gives us a consistent edge. We have a strategic asset allocation, which we think is slightly better than the peer average. And on top of all of that, we also have lower fees. So that sounds a little bit like a cheap cheat, but we can afford to be long on those measured tilts for a long time. We obviously don't want to be long for a long time. So that's why we on a daily basis assess the indicator set and assess the predictive power of the indicator set literally on a daily basis. And if an indicator is strong overweight and we can measure it still has predictive power and it still suggests a strong overweight for SA equities, and if the SA equity market continues to decline, well, their predictive power is there, the signal is there, it's updated daily. We shouldn't take the trade off as long as we can afford, and we know that we can afford to have the trade in place. So if that explains it, yeah, so no stop loss, no need for it. Thanks.
So thanks. Brings us to a wrap for today. So if you do have any more questions, please reach out to your consultant. And once again, thanks for joining us today, and hope you all keep safe and well. We'll chat soon.
Thanks, everybody.